Wells Fargo Securities head of equity strategy Chris Harvey is with us. S&P target 4625 joins us this morning at Post 9. It's good to have you back, Chris.
Good to be back,
So,
Carl.
you think that the action so far this year sort of colors your view that last year was a short covering of shorts?
Yeah, toward the end of last year, I think we just exacerbated the trend. You had a ton of short covering. If you look at our short interest portfolio, is up 15% between the Fed meeting and end of year. That tells you that people were running for the hills, right? That's over. Now we're repricing risk a little bit. You have expectations that the Fed's going to go early and often. I think we need to have earnings come out. We need to bring in expectations for earnings. That'll cause a little bit of volatility. And sentiment, as you know, is really positive at this point in time. So we could get a change in sentiment in the short term.
Is your view that calls for inflation to come down are also exaggerated?
No, inflation is coming down. But I think the Fed doesn't need to move as fast as people expect. Again, we had the jobs numbers on Friday. We have some wage pressure. We still have a strong job market. There's no reason for the Fed to go sooner rather than later. They don't get much out of it. So I think the Fed really needs to slow walk this, but we'll see how this plays out.
But even those that think that the Fed might not cut as much as the market is anticipating, acknowledge that with inflation coming down, the Fed is done hiking, for instance, and that should be bullish, certainly for companies that have dealt and battled high interest rates.
Yeah, I think that's all a fair point. I think what the Fed did is they really capped the rate market, right? So we were trying to figure out what the cost of capital was, right? We had very high, we had the 10-year go up to 5%. I don't think we're going to see that again. So really what you've done is you've taken the bottom out, right? You've lifted the bottom at this point in time. That doesn't mean that the high end goes higher. That just means you've taken some risk out of the market. And you're right, that's a positive. How bullish that is, it's to be decided.
Well, you don't think so. You don't think the market's going to go up this year?
Well, no, we really think the market's going to be more flat. What you want to do is you want to trade the market. You want to position in certain sectors. You want some risk off, utilities, healthcare, but you want to barbell that with something more positive, GARPy, which is communication, right? And at the end of the day, don't get married to positions. Really trade around them.
So what does that mean for the so-called Mag 7? It sounds like maybe you like some of them?
Yeah, we do like some of them. There's a few in that communication space. But really, if you're looking for the best risk-reward, we think your best risk-reward is in mid-cap growth. If you want to buy something, if you want to own something longer term, mid-cap growth is a place we want you to be. Good valuation, good technicals, and longer-term self-help. You don't need to rely on the economy for these things to work.
Really quick, just because we got the banks, including Wells, on Friday, where do you think? How do you think they comment on where we are right now?
I think they strike a balance. They say the consumer's okay, but don't get too excited. There's a lot of uncertainty here. We haven't gotten the credit cycle. The credit cycle hasn't hit. A lot of people are mitigating it, and I understand why. But I think they're gonna strike a healthy balance. That there's some good, there's some bad.
We'll see. That's still a few days away. Chris, good to check in with you. Thank you.
Thank you.
Chris Harvey.